Hello students and welcome to the first part of a four-part series on standard costing. So yes, we are on our very last topic for the semester and I have decided that I'm going to break this lecture up into four parts so that we can do it like Pac-Man style, I like to call it, so that we do bit by bit by bit. So welcome to this lecture. In the second slide here, I want to indicate to you how this will work. So I plan to record a four-part mini-series in which I explain standard costing. It's really a simple topic. The only problem with standard costing is that it's a lot of calculations. So we have to do it bit by bit, otherwise you might experience some confusion or feel somewhat emotionally overwhelmed by all the calculations that are required. So let's just do it bit by bit, and then we know it is easier for you to understand. Right, in the first part, we're just going to look, it's this part that we're going to discuss now. We are only going to look at our simple calculations and the basic calculations and the basic theory behind standard costing. Please take your textbook and you will find the standard costing in your new textbook. Please read through the information there and the examples there quite extensively. Please look at even the old textbook. It has a lot of information around standard costing. Please read through it as well. It will contribute to success for you. Again, we start at the beginning. What is standard costing? So in a nutshell, standard costing means that you have a budget and now the actual results for the financial year has come in and now we need to compare. So you can make note of it that actual results are never equal to the budgeted or the estimated amounts. And we need to find reasons for the differences between the budget and the actual results as cost accountants. Now, the differences between a budget and actual results for the year may occur for two different reasons. The first reason that I've listed there is because of differences in spending. And I like to call this a monetary difference. A monetary difference basically means the following. We had a budget for our payroll and we budgeted that we are going to pay our laborers 5 Rand an hour. Then actual results came in and we paid them 6 Rand an hour. So that's a monetary difference because we planned to pay 5 Rand and now we have paid 6 Rand. We also have what I like to call input differences. So these are not measured in monetary or in money terms. Input differences refer to how the materials or the labor or the overheads were planned for and how it now differs according to the actual results. A good example of this would be we planned that our laborers would work 500 hours in the next year. That was our budget. The actual results come in, they have worked 550,000 hours. So now they've worked more than we expected. So obviously our actual results will exceed our budget, but not because we've paid them more in monetary terms, but because they worked more overtime than we planned for. Similar things can happen to materials. You can plan to use, let's say, 500 kilograms of a material, and then the actual results come in and you've actually used 600 kilograms of it. So obviously there has been more losses maybe in the process, some higher normal losses, or even poor surveillance over the materials. But the core or the root of the example is that we over or underestimated the inputs that we will need in our production process. What variances do we measure? Well, on this slide, I've now put the variances that apply to this lecture or this part 1. Of course, we will add variances as we go along until we get up to part 4. In this part 1, we are going to look again at the monetary differences, variances caused by monetary differences, and then variances caused by input differences. The monetary ones are the material price variance, the labor rate variance, and the variable overhead rate variance. And then due to input differences, we measure a material quantity variance, a labor efficiency variance, and a variable overhead efficiency variance. In part 2, we will look at these fixed cost variances. You will find that those are also very interesting, and it's another set of variances that we have to calculate, but it's not covered in part 1, so that we can only focus on this little bit of simplified calculations before we get to fixed cost. There's also sales variances. This will be covered in part 3. Again, we have a sales volume and a sales price variance, but this does not apply right now. Important terminology that I just want to bring under your attention. It is very important for you to understand the difference between the words unit and input. So a unit refers to a product that is ready and complete and can be sold and distributed to the customer. That is what I talk about when I say a unit. Then there is also this principle of input. So input refers to a measurement of material, labor, and overhead. So inputs refer to hours, meters, liters, kilograms. It can be machine hours. So those are inputs because those are effectively the things that we need in order to be able to produce a complete unit. It's quite important for you to understand the difference between the word unit and the word input. So inputs, again, inputs refer to meters, liters, hours, kilograms. Right. Moving on to slide number 8. Let's talk about the lovely formulas. So I'm sure when you completed your second year, you did variance analysis and then you received a list of variances or variance formulas that you had to study. No problem. However, I've experienced in lecturing the subject that a few things happen. Students attempt to study the formula, but when you see a question, you get confused and you apply the wrong formula in the right required part, and then your answers are wrong. So I am not saying that the formulas are incorrect. They are mathematically very accurate. However, they do not work for majority of the calculations that I've seen students do because there are many of these to remember. You mix them up and then you fail standard costing, not because it's hard, but because you are in a situation where you can't remember. So I avoid teaching standard costing by applying the formula. What I do instead is I talk about the table, right, or the block. So this is the block that I like to use when I explain standard costing. It makes it very, very simple. It works as follows. You will put your requirements to make the product you will list in your first column. In your second column, you will take the actual units and you will times it by the standard cost per unit. Please note this. This is very important. I'm just going to highlight it in maroon. Then in the third column, you're going to take your actual input times your standard price per input. Again, I'm just going to make that maroon. And then in your final column, you're going to have the actual results that you will list. And then there's a pattern that you have to follow. It's really as simple as this. You will take your answer in the second column and the answer in the third column, and the difference between these two are the efficiency or quantity variance. Then you will take your answer in the third column and the difference between the third column and the actual results, and that will be the variance that represents your monetary difference. This might seem a bit abstract right now, I realize that. So therefore, I've created a little example to demonstrate how simple this is. So in actual fact, by using this block, you are applying the formula, but you are doing it unknowingly, and thus you don't have to intend to remember anything. Because at third year level, you don't get a mark for the formula anyway. So going to slide 10, I have an example, and it says here that VUT Limited produces a single product that has the following standard cost. So in the first one, they say material, and you need the inputs are 2 meters at 10 Rand per meter, and then the unit cost of material is 20 Rand. And we get to this answer by saying 2 meters times 10 Rand per meter. So the meters is the input, the 10 Rand is the price for the input, and the 20 Rand is the unit cost. For labor, we have an input of 3 hours at 6 Rand per hour, 6 Rand per input, with a unit labor cost of 18 Rand. Then we have variable overhead, also 3 hours at 3 Rand an hour, so it's 3 hours input at a price of 3 Rand per input, and the total unit cost of variable overhead is 9 Rand. Then it says their variable overhead is based on labor hours. That will make sense because there we had 3 hours, there we had 3 hours. So they've used that 3 labor hours to calculate the variable overhead as well as allocation base. Then it says budgeted sales and production units are 10,000 units. Then we move on to the actual results. So the actual results is what really happened for the year. So once the end of the year came, the financial accountants will now account for everything, set financial statements, and that's the actual results. We have it in, and now we've discovered that there's 12,000 units that were actually produced and sold. Material usage of the material was 20,400 meters. So that's your actual input at 9 Rand 50 per input per meter. Then there's some labor wages that amounted to 211,200 Rand. The actual input in terms of hours was 38,400. And then we have variable overheads that amounted to 134,400. Right, with that information, let's use this example and then move on to the block and fill it out. So the first one says actual units times standard cost per unit for material. If I go back to my information, the standard cost per unit of the material is 20 Rand. And then the actual units for the year was under the actual results, and it was 12,000. So for material, I'm going to say it is 12,000 units. I'm just going to use the U, it stands for units, times 20 Rand. And that gives me an answer. I have to use my calculator quick. I get an answer of 240,000 Rand. If we move on to labor, in the second column, we still need the actual units times the standard cost per unit. So the standard cost per unit of labor was 18 Rand per unit. So it's going to be 12,000 actual units, and I'm going to times that by, I think it was 18 Rand. Yes, it's 18 Rand. And that gives me an answer of, I get 216,000 Rand. For the variable overhead, if I go back to the example, the unit cost was 9 Rand. So I'm going to take the actual 12,000 units. I'm going to times it by the 9 Rand. And that is going to give me 12,000 times 9 Rand gives me an answer of 108,000. I'm moving on now to my third column, and that says actual input times the standard cost per input. So let's look at the material. What was the actual input for material? If I go to my actual information, the actual input was 20,400 meters. So I'm going to type it in. 20,400, I'm going to say M, that's meters, and I need to times it by the standard cost per input. So I'm going to go back to my standard cost, and now I need to look at the standard cost not per unit but per input, and that is a 10 Rand that I see there. So I'm going to times it by 10 Rand. And if my mathematics is not too poor, I believe, let me just type that correctly, it is 204,000 that you will get to there. For the labor, we need to go to the actual input. So I'm going to go back to my question. The actual input was 38,400 hours. What was the standard cost or the budgeted or planned cost for a labor hour? It was 6 Rand. So it is going to be then the 38,400 hours times by the 6 Rand, and I get to an answer of 230,400 Rand. For the variable overhead, I am going to look at the actual input. However, I am told that variable overhead is based on labor hours. So I still need to use labor hours as my input. So the actual input there will also be 38,400 hours. And I'm going to times that by what was the standard rate or the budgeted rate of an input. It was 3 Rand. I'm going to times it by 3 Rand, and I get to an answer of 115,200. The only block that is now still left to do is the actual results, and that's normally quite easy because for the labor it was 211,200, so I can just go and type it in 211,200. For the variable overhead, it was also given very straightforwardly, so that is 134,400. And then we only need to calculate the actual results of the material. So for actual results, we're going to take the actual input times the actual price paid to get to the actual answer. So that is 2,400 meters, and we need to times that by an actual 9 Rand 50. And I get to, if I type that into my calculator, I get to an answer of 193,800. Great, you've completed your block. It's really as simple as that. So you need to know this is the unit cost, this is the input cost, and these represent the actual inputs for the year. Now, the difference between the second and the third block is your efficiency or quantity variance, and the difference between the third and the fourth column is your monetary difference. So if we now calculate our final answer, we're going to say, all right, I have a material price variance and I have a material quantity variance. And I just like to list my variances always because you actually do get marks for knowing the proper names of the variances. Then there's a labor rate variance, which is the monetary variance of labor. And then there's a labor efficiency variance. And then we also have a variable overhead rate variance, and we have a variable overhead efficiency variance. Great. So these are the ones that we are focusing on today. Both monetary and those that are caused by differences in your inputs. Then I'm going to use this for just to show you the calculation. Please show your calculation in a test. Very, very important so that we can see where you got the figures from. So the material price variance, and this is the rule if you apply the block. So we work from left to right. In other words, the material price variance is going to be 204,000 minus 193,800. And that gives us an answer of 10,200. And because the answer is positive, it is favorable. So, and if we look at it, it makes sense. We are looking at a price difference. We planned to pay 10 Rand. We paid 9 Rand 50. So that is favorable. We've made a saving. Great. We are on the quantity variance. The quantity variance is the second column minus the third column. So it is the 240,000 minus the 204,000. And that gives me an answer of 36,000 Rand. And if I type it into my calculator, it is positive. So again, I show it's favorable. Please remember to show favorable or unfavorable so that you do not lose marks in a test. We have the labor rate variance that we're going to calculate. So now we're going to repeat the process. I'm going to go to labor and I'm going to say the rate variance is then the 230,400 and I need to minus the 211,200. So I'm going to type in my calculation, 230,400 and I need to minus the 211,200. I'm just making sure that I am using the right figures here. On my calculator, I get a positive 19,200 favorable. I go to labor efficiency. Labor efficiency is then the second column minus the third column, so it's 216,000 minus this amount of 230,400. And I get to an unfavorable answer now of 14,400 unfavorable. Let's do it one last time. We're going to repeat the process for the variable overhead. We are looking for a rate variance, a monetary difference. So it's going to be the difference between the third and the fourth one. So it's 115,200. I'm going to minus from that the 134,400. That will give me an unfavorable answer, and I'm typing it into my calculator. I get an answer of 19,200 unfavorable. I'm just going to double check, make sure that I don't make finger errors. Yes, 19,200. We are on the last one, the efficiency variance, which is the variance in terms of your inputs. And there it's going to be the second column minus the third column. So it's 108,000. And we are going to minus from that the 115,200 in the middle. The answer there also seems unfavorable to me. and I get an unfavorable figure of 7,200 unfavorable. All right, so this is part one. This is what I wanted to demonstrate to you in terms of using the block. It's really easy. You need to go and find your unit cost, your input cost, your actual input, your total actual units. You slot everything in, and then the difference between these two is a monetary difference. The difference between these two represent an efficiency difference. You go and you fill it out, and this is how you will get full marks for your calculations for standard costing or your first introductory simple calculations in a test or an exam. I hope that you have enjoyed this part one. I hope that you've learned something. And yes, please let us know if you have any follow-up questions. I will, of course, also make available full standard costing question examples in videos later on. We cannot expect of you only to do these little examples, but you will then see how all the examples come together. Right, until we meet again, have a good one.